Before we get started, I just want to make a reminder to everybody that the information discussed today is not to be interpreted or construed as investment advice. Everyone's financial situation, goals, and objectives are different. Please consult investment advice.
The dirty secret is that no one's ever going to get paid back.
People have the shortest memories when it comes to investment.
We just got to get Keith into Bitcoin.
Hey, there's a bubble.
Welcome back to the Loonie Hour, episode 22. As always, joined by the three amigos. We've got Rich Diaz with Acorn Macro Consulting in the sexy white dress shirt, the Tom Brady of macro, and we've got Keith Dicker of IceCap Asset Management in the Patagucci jacket. Welcome back, gentlemen. Lots going on in this week. I mean, we're actually filming this a day earlier, but I think everyone's talking about it is the escalation in Russia, Ukraine. So we'll certainly touch on that aspect. The commodity boom, which we touched on a little bit on the last show, how that filters through into potentially, probably higher inflation, potentially structurally higher inflation over the longer duration as this sort of deglobalization escalates. And so I want to kind of open up today's show with sort of a question to you guys, because I posted this on Twitter the other day, kind of making a joke, right? And I basically said, so just confirming that we're still on for 8 rate hikes this year. And basically my view is that you've got higher inflation, but I think it seems to me almost inevitable that we're going to go into a recession here. I mean, anytime oil prices hit as high as they do, there's a pretty long track record to suggest that starts to bite into the consumer. Again, oil is the lifeblood of the economy. It's an input cost into almost everything in our day-to-day lives. And so that was kind of my view. And obviously central banks, they're going to keep tightening into a recession. So that's the question, because there was a lot of feedback saying this, Steve, you're an idiot. You don't know what you're talking about, and perhaps rightfully so. But I want to take that to you guys, because they're like, basically, this makes a stronger argument. Don't you know that this commodity inflation is going to cause even more inflation? Thus, central banks will do the right thing and raise rates even more than what is currently priced in. So there was a lot of that view, right? Don't think about the recession. Central banks are they're going to do what they need to do, which is fight inflation. That's the moral thing to do. And because of the war in Russia and Ukraine, that will create more inflation, thus more tightening. Rich, I want to get your thoughts on that and get your views on that dilemma.
All right, cool. So a couple of things. I laugh when you said, are central banks going to do the right thing? I think, have we learned nothing, people? Central banks do almost never do the right thing. And so this idea that they're going to do the right thing now, starting now, because they, have a come to Jesus moment, I think is laughable at best. A couple of things. I think number one, this is not the quote unquote right kind of inflation that I think central banks can affect with central bank rate hikes, 200 basis, 400 basis points, 1,000. It doesn't matter if commodity prices continue to get elevated. I mean, they're down today, but if they continue to ratchet higher because of war or because of embargoes and sanctions and all kinds of stuff like that, it's not clear at all that any amount of rate hikes, short of, I guess, totally collapsing demand and just, driving the economy into the ditch, would have any effect on inflation at all. Anyways, that's the first thing. The second thing is, I think, and then the final thing is, I think it's really important to remember what they're trying to do. They're just trying to remove the kind of excess stimulus. And so it's not clear at all that they want to, quote unquote, materially tighten. Even if they do raise by 200 basis points or 2% or whatever, I mean, real rates will almost certainly still be negative. And policy will still be easy. And I think they're very acutely aware that this is sort of the wrong type of inflation to be fighting. I don't know, Keith, if you had a different view on that.
Yeah, sure. So first of all, we got to look at, there are 3 kinds. Inflation comes from 3 different markets or 3 different areas that Rich just introduced. The first one is that demand is really strong. And that's the kind of inflation that central banks, they can control, or at least, try to influence. So by creating an environment where demand will weaken or demand will strengthen, depending on what they want to do with the economy. Then you have inflation that's driven by supply. So if there's too much of stuff on the market, prices are cheaper, and then the opposite. And then the other kind of inflation, of course, is FX related. So let's just say, for example, the US dollar just surged, it went up through the roof. Inflation, all else being equal, it declines for the Americans, but it rises for everyone else in the world. So you can always have that situation that's happening. Central banks right now, it's incredibly difficult for them raising rates, trying to affect inflation that's driven by the supply lines being shut down. And then, of course, you look at what else is happening out there around the world. However, though, they have the pressure. They got the social pressure. They have the political pressure right now. They're getting pressure from banks, financial markets, specifically on the front end of the yield curve, in overnight funding markets. They're telling them, yeah, you got to raise rates to keep up. So you have all that taking place. And so, Steve, when the people, I think they're being a bit, when people are saying central banks, they have to raise rates aggressively 8, 9, 10, 12 times because inflation is surging. I just don't think they're not completely aware of the total picture, because you will get to a point where it will break. So I know we've discussed it here on this show before, that we do not expect the Bank of Canada to do, what was it, 7 or 8 rate hikes? I think the number's thrown out there. We've always said, 3, 4, or 5, and then we say they get stopped out. So the way they get stopped out is that some other exogenous event will take place, which causes them to pull back. And right now, it is happening, with what's happening overseas. But so a couple things on inflation right now. People are now no longer talking about the global supply chains being shut down. Like COVID, no one talks about COVID anymore. Like, inflation was not created by that. And all of a sudden, inflation wasn't created by central banks having low rates, or government spending too much money, or commercial banks lending out too much. It's Russia. So you remember the Brady Bunch years ago? He was Marsha. You guys don't know that. Oh boy. Oh dear.
Here comes
You can
here
do
comes
better
the
than
story.
that.
Here comes the story.
Yeah. I will tell a story, but I'm not going to use the Brady Bunch as a
Wait, before
story.
you get into the story. Okay, finish this thought.
That's not a story. I'm not using the Brady Bunch.
Okay.
And I'm be very wise with my storytelling. But anyway, right now, like for example, over the last 2 days, I saw this headline from on Bloomberg. Rising gas prices. It's Russia's fault. All the American big newspapers, like in Chicago, the Tribune, the Times, over in LA, and even up in the Bay Area, like it's all the gas prices because of Russia. And it's contributed maybe over the last, to get it moving. But, as we've talked about quite a bit on the show, like this hard left turn towards improving in a reaction to climate policies, that's what's really tipped off, the surge in inflation, and then the lockdown economies and all that stuff. But again, this is another case where people have very short memories. They're very focused on now, the big bad Russians are causing inflation. And it's not the Russians causing inflation. It's been here before. And it's, we are going to get a reaction to it. So the best part about the conversation today that I'm excited about is what the central banks are going to do and what some of them are not going to do. Because I think and next week, guys, we have the Fed coming up. And I think it's going to create a really big moment. Both guys want to whoa here.
What they're going to do versus what they should do. Different things, please. People, reminder, Rich, go ahead.
Well, I think that there's another way of thinking about it, which is why I think you were right to start us on this track. And I think that it's not just the Fed or the Federal Reserve or the Bank of Canada that can tighten monetary policy. If you think about it sort of philosophically, what is tightening? It means the access and creation of money and the price of that money. And there's different things that can affect that price of money. One of the things that we've seen recently over the last few weeks is sort of the front end of the yield curve. So the 2-year bond yield has shot up from, I can't remember, 50 basis points to 160 odd basis points. That's a form of policy or tightening. The other things that affect tightening is a lower price earnings ratio, or another way of describing that is if the equity market tanks 30%, trust me, that'll affect the way people perceive the cost of capital, and it'll affect something called the equity risk premium, of course. Another thing that's another way of tightening is rising input costs, e.g. oil. So that's another way. So if you have a massive increase in oil prices, you can think about that as a way of sort of tightening or sort of gumming up the works of your economy, right? And then the other two ways I think are just simply the dollar. So the dollar rising rapidly, that, trust me, that quote unquote tightens monetary policy in jurisdictions outside of the US for sure. And then the final way is confidence. If you think that the world is going to end in global nuclear holocaust, then you're not going to be as keen on lending to your neighbor as you were 3 weeks hence. And I think that those are other ways that you can have sort of philosophically tighter policy or monetary policy without having the central bank really do anything at all. And so that's another way of thinking about it. So I think that's just something important to think about.
Yeah, I think that last point's really important because, like I said, I obviously work day to day in the real estate space, and so I'm always like very cognizant of sentiment, right? Like what's home buyer sentiment, and home buying, particularly in Canada, is like it's a massive driver of our economy. So like housing market slows down, we will feel that months down the road. And so I'm just seeing it today. It's like sentiment's changing, right? Like people are like, oh, there's a war out there, gas prices are going up. Like people are uneasy. They're uneasy. They're uncomfortable. And so, you're starting to see that some of that activity pull back, right? That speculative fever it's just not what it used to be. And so, yeah, I think that it's that sentiment. And so, yeah, the tightening, as Rich pointed out to, can come from many, many factors outside of just central bankers. And I think that's kind of the argument that we're making today, is that the market is going to do a lot of the tightening for the central bankers moving forward. Funny you were actually talking about, Keith, you're talking about governments and the oil and gas policy. It's pretty interesting. I don't know if you guys saw, I love him or hate him, but Elon Musk was out on Twitter this week. He's, quote, hate to say it, but we need to increase oil and gas output immediately. Extraordinary times demand extraordinary measures. He went on to say, obviously, this would negatively affect Tesla, but sustainable energy solutions simply cannot react instantaneously to make up for Russian oil and gas exports.
No shit, Sherlock.
But it's just like, and then again, guys, this is a guy that's like literally disrupting, the combustion engine here. That's, and the fact that he's coming out and making a claim like that, I think you have to be cognizant, because I'm just seeing it again. We joked about it on the show before, but you go in Vancouver right now, a liter of gas is over $2. I think we hit $2.10 a liter. Part of that is obviously government related, i.e. Carbon taxes, which are set to go up in BC here on April 1st again. And people are going, gas is $2 a liter. What the hell? Government needs to fix this damn war in Russia. It's like, government created a lot of the problem, guys. When you tell oil and gas companies to stop, exploring for new supply, you run into these sort of problems. And so Russia, Ukraine is kind of the icing on the cake. And I don't know if you guys want to touch on some of this energy policy in Europe. I know Rich is probably dying to get in there because Canada's, we talked about it, I think, on the show last week. Canada sanctioned Russian oil, which was basically just lip service. I think the US has now done the same. So it kind of puts Europe in a pretty tough spot.
I want to say one thing first. I don't know anybody that owns a Tesla. I really don't. So
well, you're looking at him.
Does.
It's a good car, okay? I'm doing my part for this world.
Coal powered,
baby.
I mean, let's not get like in this huge tent. Let's not go down this road too deeply. But like green energy policy, the lie that they told everybody, number one, is that it would be cheap, which I can assure you it's not. Just if you, Steve, if maybe we can do a podcast where you take apart your Tesla and tell us how much rare earth minerals it requires, rare earth metals, and how much excess copper it would require to basically create an electric vehicle versus an internal combustion engine. The other lie that we were told is that it would be painless. And we're obviously feeling the effect of not investing in oil and having capex to sales be at 20-year lows. And the other thing that I think is kind of a circular thing, which is that we were told that peak demand was on the way. And I think oil companies share a lot of the blame with respect to, they sort of bought the line that peak demand was on the way because, in order to basically navigate a world of peak demand, why produce and why invest? You know what I mean? We can blame energy policy all we want, but we have to also, there's the share of the blame of the people who run these companies. And then finally, a technical point, which is the inventories are super, super low. They're back to 2015 levels, something like 2.5 billion liters in the OECD. And that's not a lot. And so, we can squawk all we want about Russia and this. Nah, it's all these things are way more complicated than I think any of these tweets or politicians or headlines ever want to get into. I don't know, Keith.
Yeah, Keith.
Well, so first of all, I said before, Europe is absolutely screwed when it comes to the situation they're in right now. And the only way they can get out of it is if they do. I do think the Eurozone will restructure. I think this genie that's come out of the energy bottle, they cannot stuff it back in. So I think it's inevitable that there will be stress created within Europe. And specifically, the Germans are going to say, hey, we've had enough of this. We've carried everyone. We're out of here. And by the way, we're going to take oil again, we're taking nat gas from the Russians. And I know it's still flowing and stuff like that, but there is so much stress within Europe. So as an example, so for people who are not aware of it, the Eurozone is the collection of 19 European countries that they said, we're now going to use the same currency and have one central bank to create monetary policy for all of us. So it's all of Europe, except for Switzerland, except for Denmark, except for Sweden and Norway. That's what's so funny about the Eurozone and the EU. Now, of course, Sweden and Denmark, and they're part of the EU as well, of course. But the point is, Europe it's a pretty complicated, messy place. But it's also very simple in that the reason the Eurozone fails is that they do not have federal debt. So if, the old joke, I think the Americans have it, hey, if you have to call Europe in a time of crisis, who do you call? There's no one person. You either call the Germans or the French, right? That's it. But there's no federal debt. So in Canada, Ottawa, they'll issue federal bonds. And with the Americans, they've issued treasury bonds. In the Eurozone, there's no federal bond out there. It just doesn't exist. Each country will continue to issue their own bonds because the moment they issue a federal bond in the Eurozone, it means that everyone becomes responsible for paying it back. Which means that gives, that scares the crap out of Germany, of course. They're saying, well, the Italians may not pay it back. The Greeks definitely won't pay it back. You can't trust what they're going to do in Spain. And the French, you don't know if they're going to show up at the line. You just don't know, right? So there's always been a huge pushback on that. Suddenly this week, I don't know if anyone noticed, it really caught my attention. Now they're whispering signs of maybe issuing federal debt across the zone. And it won't happen, but it gets floated out there because the euro is one of the worst performing currencies in the marketplace right now. Because economically, they're really getting their screws tightened here.
Of the majors.
Yeah, absolutely, the majors. And yeah, Rich, those Russian equities aren't doing well, right?
No, they're not.
They're not doing well. But my point is that it's gone down this road, and I really do not know how they can fix it or correct it, which sort of leads back to the central bank discussion. When everyone I think Steve, you mentioned, they're saying it's crazy. They have to raise rates by, 100 basis points or 1% and 2%. Real rates are like -4%. Like, it's crazy stuff. The Europeans, they will not be raising rates. They're trying to talk up a good show that they will raise rates, but they will not be doing it. Next week, the Americans come out. So the Federal Reserve is going to come out. They are absolutely raising rates, and I'm expecting them to sound very hawkish. And it could be, that's the door that opens. That could cause a pretty big, it could prick this balloon out there with all these commodity prices going higher. It's the name of the game. I know Rich has been, extremely positive and bullish on the energy sector now since we started the show, and he's been absolutely right. And it's funny, Rich and I bumped into each other yesterday, and he's sort of laughing a bit. I don't know if you want to tell the story or not, but
go.
Saying, yeah,
I remember, so go for it.
Well, Rich said,
you guys had a party on Friday without me.
No.
Yeah, I know that one. It would have, imagine if Saretsky showed up, hey?
Oh boy.
But no, Rich was saying, like, now people want to buy energy stocks, right? And you don't do it now. Like, this is at the top. So actually, I have a story. You guys want to hear a boomer story?
Take it away.
It might fall flat, but we'll give it a try. So I'm trying
Thanks for listening, guys.
Yeah, I know. Here we go. Okay.
You can turn off the podcast now.
Long time ago, before the internet was invented, Boomer was out one night with his university friends. So we're on George Street in Newfoundland, if you've ever been over that way. And it's kind of like really late at night or really early in the morning, whatever you want to call it. So we're at this pub. It's a multi-tiered place, like a Thunderdome sort of. And anyway, one of the gimmicks they have late at night, they have this Velcro wall. So somebody can put on a Velcro suit, and they have like a mini catapult or trampoline thing that you jump on. And the trick is to run the length of the bar, and you jump on it and you spring up and try to hit the Velcro wall. And then, it's a good bit of fun. So my friends thought it'd be a good idea to put Boomer in the suit. So they do that. So here's Boomer at, 3 a.m. Van Halen Jump is playing. If you guys don't know that music, but it was cool back then. 400 people are screaming. All of a sudden, I'm starting running for it, and I don't even hit the catapult, just the thing they had there. I miss it, and I just run straight into the wall. I'm about 2 inches above the wall. My friend said it was a good idea that I missed the window, because otherwise I would have went out a couple stories. But the point is, this ties into energy stocks, guys. If you're running out buying energy stocks today, it's probably equivalent of putting on a Velcro suit at 3 a.m. at a bar to jump into the wall. This might be a better opportunity to do it. So that's the
oh boy. So
the point is, you have a good opportunity. Like even here this afternoon, oil dropped from about 125 this morning down to 105 very quickly. This could drop down to like $80 in a hurry. So it'll be similar to the euphoria we had in cryptocurrencies last year. Again, I think we're in that market. So long term, it's really positive for energy, but you might want to be a bit patient about going into that market.
Rich is shaking violently.
I'm shaking because I want to push back on the euro thing. And it's not that I don't think that...
Hold on. I want to make a comment. We will have one of those Velcro suits at the Loonie Hour gala in Vancouver this summer, which is still in the works, but we will do a live meet and greet sort of event for all you wonderful listeners. So we'll see if we can get Keith to put the suit on and go for a jump. But yeah, Rich, feel free to fire back.
Well, listen, I get that euro is a basket case. They've made all kinds of shitty policy with respect to immigration over the last few years, over Greece, over energy. There's all kinds of shitty things. But one of the things reason I don't necessarily, Keith was skirting around the topic of a broken up euro. And I think one of the reasons I think the Germans will do everything in their power to keep it intact and eventually will capitulate and do some kind of federal euro United States of Europe bond and actually do everything in their power to keep it is because of the way that their economy is structured. Germany has a current account balance of 7 or 8%. Basically, they have enormous amounts of exports. They don't really consume that much. And most of their growth has historically, for the last since they joined the euro, been growth oriented. And that's the function of that is because being tied to these, sorry to say, shittier countries, basically has artificially dragged down the theoretical Deutschmark. And as soon as Germany leaves this euro, their quote unquote Deutschmark, this Deutschmark version 2.0 or 3.0, whatever we are right now, would shoot up 30 or 40%. and all of their economy, which is export oriented, would be 30 or 40% less competitive. And so the if you think BMWs and Mercedes-Benz are expensive today, imagine if you had to buy it in some kind of new German mark. And so I think that they're and the Germans refuse to restructure their economy, e.g., consume more and invest more. And so unless they're willing to do either one of those things, which is consume or invest, or accept a Deutschmark that's 40% higher than the current number, I don't think that they're ever going to do sort of what maybe they should do, which is separate themselves from the euro. And I know we're getting quite down this crazy tangent, so forgive me, but I have to push back on that view. I don't agree at all.
Yeah, okay. It's good that people always say you guys always agree on everything. We need some new guests on the show. So I always enjoy that you guys have a little bit of back and forth. I'm just the moderator here. But I kind of want to bring this.
Whoa.
Shoot.
What is one thing Rich forgot to mention? That there's two sides to every coin. So Rich is correct that basically when the Germans joined the Eurozone, the currency went from, like in USD, like a $1.70 down to a $1.05. That's incredibly awesome for them. The Italians and the Spanish, their currency went from effectively 50 cents up to $1 USD. So you could, as I said, hey, the Germans could kick out of this. The Italians definitely want out of this, because the way you restructure your economy,
that's fair.
You can either change interest rates or spend more or spend less money, and they're not allowed to do any of that because, again, the Germans through Brussels tells everyone what they're allowed to spend. So the other way an economy can adjust is by using the relief valve, which is on the currency side. And again, the euro is strong because of the Germans are attached to it. So remember, Berlusconi, he wanted to pull out of the Eurozone in 2012. And it was in the middle of the night. The Eurocrats went in and literally they yanked him out. They said, you're out. And they put Mario Monti in. He was a technocrat out of Brussels. Now, here we are now, like 10 years later. Who's the president of Italy?
Mario Monti?
Mario
Draghi. Mario Draghi.
Yeah.
Sorry. I knew that.
Guys, it's the biggest swamp in the world. It literally is.
But you can't deflate. You can't deflate your way to prosperity, though. That's the other. We're going to get down.
We know that.
Oh.
We know that. However, but they believe they can, and that's the point. And that's the same thing with every single country.
Okay, so I want to circle this back because I'm going to square the peg here, basically, which is at the end of the day, we have massive geopolitical shifts underway right now. The world is, becoming sort of this deglobalization. What's going to happen to all these nations? Who are in the best positions to sort of come out of this? How does the world look 2, 3, 4, 5 years from now? I'm kind of curious to hear, again, this is a Canadian show, obviously. So how are you guys looking at this, not only from the Canadian dollar perspective, but obviously we've got a lot of commodities, for one. Number two is I think that we're going to see a lot of reshoring of supply chains. Hopefully, Canada starts getting back to that way and investing in research and development and some manufacturing here domestically, because that seems like it's becoming critically important. So is our energy policy. How are you guys viewing this? How do you view the Canadian outlook over the next 5 years, regardless of who's in power, politically? But do you think that we're in a good position here on a relative basis?
Yeah, I think on a relative basis, we won't be first up. But I think within the next, you said 3 to 5 years, Steve, I think there will be a significant restructuring of global debt around the world. I think that's what we're headed towards.
Bold.
If that doesn't happen, it means that we grow extremely slow, so that all entities can gradually continue to, because everyone has to issue more debt than they're able to service. They have to try to do that somehow. But Canada will not be up first in terms of restructuring, but it will be involved with it. I know you didn't say, but I will introduce something that's very extremely important that's happening right now on this side, because we have a lot of of course a lot of information, a lot of news coming out of Ukraine and Russia right now. But the Americans, they're going ahead with their digital asset policy, and it's under the guise that we have to put this in place, control crypto, so that that way the Russians won't be able to transact their economy and so forth. The Bank
I think
of
this
Canada,
regulation's bullish, by the way.
yeah,
coming from a millennial.
Just letting you know, like the central banks around the world, including the Bank of Canada, they've been front and center. They want to come out with a central bank digital currency. Yep. And the reason they want to do that, because they can see is a bit of a crap show coming up here in the debt world. So they need to have everything lined up first to be able to support the system. So and again, this creates like incredible opportunities, and it's great for Canada because we won't be the first one to experience it. But I think anyone, if you do have the vision to see it, it'll be pretty good.
Rich, do you have any comments? Because I want to circle back. Like I want to get your comments, and then I'll
make it quick.
I want to touch on something.
I'll make it quick. So I think Keith did a really good job. Agree or disagree with him. I think he did a really good job sort of framing it from a financial market perspective. I'm going to frame my answer just from a macroeconomic perspective, which is I think Canada is extremely well positioned. Despite the misgivings I have on obviously the housing market, debt, and stuff like that, I think we have extremely good population growth. That's good in general. That's really good for growth. We're really close to an enormous benevolent trade partner, mostly benevolent trade partner, and we're extremely well integrated with that trade partner. That's the U.S. They pay for all of our defense spending, so we don't have to, and so we get to be a free rider. And then the final three things, which is we have energy, shitloads of it. We have water, fresh water, shitloads of it. And we have raw material, so basic raw materials. So basically commodities X energy, shitloads of it. Pardon me, I was told I shouldn't swear. Lots of it. And so if Canada wants to exploit those resources in a safe and ethical way, the only thing standing in Canada's way is politicians unwilling to exploit our natural resources in a safe and ethical way. I think Canada is extremely well positioned. We have lots of real assets.
You left out one more thing that Canada
and we have lots of hockey players.
There's one more thing that you forgot to mention that Canada has a lot of.
Boomers.
Well,
maybe. I don't know. We have lots of foreign. I have no idea.
Debt. We have lots of debt. So
I know. But you said we were going to restructure the debt.
Yeah, but on the way to get debt restructured, you got to come out the other side, and that's my point.
Yeah. But what I didn't. I wasn't. Yeah. I was trying. I didn't want to disagree with you at all. I was just saying from a totally purely like a fundamental standpoint, like how can we navigate?
One thing the Italians talk about quite a bit, and the Canadians don't do it too much, but the Italians have this incredible current account balance. So they sell a lot of stuff and then they buy less than what they have coming in. The Italians have a current account surplus.
For the first time in 10 years, but anyways, carry on.
They're pretty good, yeah. And I had this conversation with a lot of Europeans. They're like, yeah, we're actually really awesome. And I said, no, that number means if you exclude all your debt, you're pretty good at what you're doing. They said, yeah. I said, well, you have to include the debt. And then that's my point around the world. People that have too much debt, it is something is going to come up here. I know I sound pretty bearish here today. I don't mean to, but again, guys, we're at the stage where rates are going from zero and higher. There's global conflict taking place. The energy markets have been just shut down. A lot of money can't flow through the SWIFT dollar system again. Like there's going to be some pretty big losers coming up, and capital is going to gush around as a result of it.
Boomer's seen a few things, so
I was wrong. Current account balance has been strong since 2012, since the crisis. That's right.
Wait.
Twinkie.
I was thinking of Spain.
That kind of brings me again full circle to sort of my next point, which was I don't know if you guys saw. I don't know how familiar with you. I'm sure you guys are, but so he's been making the rounds this past week. Zoltan Pozsar, he's kind of the I don't know what you'd call him. I call him like the granddaddy of like financial plumbing. So this guy's kind of seen it all. He's had some good calls over the past, so he's very well respected in the space. But he put out a piece that went viral. A couple people sent it to me, but basically, and this guy works for Credit Suisse. So Bretton Woods, he's calling it Bretton Woods III. So he says, I'll just read his portion of his paper here. We are witnessing the birth of Bretton Woods III, a new world monetary order centered around commodity-based currencies in the East that will likely weaken the euro-dollar system and also contribute to inflationary forces in the West. Crisis is unfolding, a crisis of commodities. Commodities are collateral, and collateral is money. And this crisis is about the rising allure of outside money over inside money. Bretton Woods, number two, Bretton Woods II, was built on inside money, and its foundations crumbled a week ago when G7s seized Russia's FX reserves. So I don't know if you guys have any comments on that, but I think it's a really important dialogue, and it's pretty far out there. I mean, it's I think we're going through a changing monetary order here.
Do you want me to go? Yeah. So I like to say that that's similar to the view. So we've been talking about this kind of stuff for a while, and I'll always say I think we're going to be 75% correct. And another way, or a easier way to say what Zoltan is saying, is that we're going to have a different monetary system coming up. It's going to happen, whether it's commodity backed or something backed, who knows? But the point is, something will break in between. And when all that breakage is going on, it can't be over a weekend. Like, again, everyone's getting ready for it because the central bank digital currencies it's out there, but they'll try to hold things together as long as they can, but eventually it will break. And then there's a new system. So he's suggesting it's going to be a commodity backed system. And I don't know what it's going to look like, but one of the stories out there, your currency will be linked to gold. And as great as that sounds, it doesn't work. It means your economy will instantly collapse. You become deflationary because you're not able to expand the currency or the credit in your system because you're pegging it to gold. You need more gold all the time.
Stupid system.
Any gold bugs out listening? Like, how much production can you get a year? Like, it's not an exponential. You can't create it. So that's what the good stories for crypto. They say, hey, as long as we have some energy to make crypto, it'll be good. But again, the point that he's making, and I know his work quite well. He's really strong in like overnight funding markets, what's happening in that space. This is the first time he sort of jumped over into that world, and it can be a bit, I don't know what the right word is. You could be in disbelief if you read it, but what he is correct with is that something is going to change out there because of this debt. It's not sustainable. And he is right that the system has shifted dramatically because of the response to the Russians.
Rich, I was just going to say, I mean, it sounds scary, I think, because change is scary, and I've been on record as saying I hate change, but this has happened many times before. I mean, the Bretton Woods, for people that don't know, that is the name of a hotel or resort in Washington. I think we've talked about it on this podcast before. I mean, it's just a bunch of people sitting together, trying to figure out how the world will conduct business over, a indeterminate amount of time. And this happens a lot. I mean, there's different treaties every little while. And, the earth is still here, we're still here, and people still do business. And I think that's just something, it's just how do you position yourself for sort of that shift? Just back to your point about the commodity-based system, Keith stole my point, so I won't belabor it, but it just sounds like I don't know. The reason I don't buy it is because it just sounds like another gold system and a gold-backed thing. Commodity is just a fancy word for some element that you have to dig up out of the ground. And so, he made it sound fancy with the word commodity, but I would just say, doesn't that sound like gold? And that never works because you can't expand Fiat system works in a way. People hate it now because central banks have screwed it up. but it makes sense that you can expand and contract your money supply outside of a person with a pick and an axe and a shovel. So I think it's really, really important to remember that.
So one thing here, I have been to Bretton Woods, and I've climbed the mountain next to it. I hung out in the gold room. And I do encourage anyone to go to Bretton Woods. It's one of the most beautiful resorts I've ever been to. But everyone should remember, Bretton Woods, these big events, they happen after the crisis. It never happens before. So Bretton Woods was the result of the conclusion and the wreckage, all the rubble lying around from World War II. So we will get another one, Bretton Woods III, whatever they want to call it, but it'll be after we deal with this gobs of debt that's out there. And I'm excited about it from a financial perspective, because I think you can make a lot of money, or worse still, you can preserve your money. And a lot of people, like to say with their investment portfolios, they're standing in the highway in the middle of the night, and that's not two motorcycles coming at you guys. That's a big truck, right? You can't stand in between the lights. So that's
so I mean that's a good question. That was actually kind of leads to my next question, which was, so you got a lot of people listening to the show, and they're like, okay, Bretton Woods III, commodity price inflation, changing world order. This all sounds very scary. What the hell do I do? And I know you can't give direct investment advice, but like, can you give any sort of like guidance? Like if someone's just like, listen, I need to like, how do I position myself for like the coming sort of change and volatility that will encompass that change?
Can I just jump in there quickly with like one 2-word answer, which is tangible assets would be the way I would say it, but Keith, I'm sure, has a much more kind of.
Are you talking about like strictly like hard assets, like
yeah? But
like
that means
gold,
whether it's
real
land,
estate, commodities,
whether it's land. I mean, whether it's physical gold, whether it's your house. I think it's very, whatever your house is priced in, whether it's bananas or Cocoa Puffs or whatever. I mean, it's still standing and you can still use it. But I'm sure there's much more kind of elegant and more sophisticated ways, which Keith will tell us in a minute. But for me, it's tangible assets or claims on tangible assets.
I wouldn't be fearful of it. I think what's really great today is there are most investors today, they have access to a lot of different sources, like such as this show, for example. And other, like, again, guys, Twitter is outstanding. You can get really close to some really smart shops out there very quickly, and you're able to just educate yourself and enrich yourself. And then when you're armed with that, go ask whoever you're having your money managed, ask the right questions, understand it, and then you can set yourself up for it. I don't think it's necessary. There's only two ways, only two things you can do. Yeah, there's a lot of things, but as long as you understand where the risks are, and then you're able to, because there's lots of tools out there to help protect your money. Like there really are. Curling up in a GIC, that's not one of them, because you're on the bank's balance sheet if you do that. But that's a very important consideration. People don't understand that. If a bank gets in trouble and your money is on the bank's balance sheet, you just become a creditor to the bank. If you're in an investment portfolio, your assets are segregated from the bank's balance sheet. So in Canada, they have specific rules for that, and you have to worry about those things. But again, like people have easy access to more information today, and the more you know, the better informed you'll be. Again, I'd be very excited about it.
Yeah, well, I mean, kind of brings me to a point as well, just to kind of, as we're talking about all this, we opened up the show around, rate hikes and how much they can hike and blah, blah, blah. There's a good piece that was put out by David Doyle, McCurry Research. So he's, again, pretty respected guy here in Canada, but so he put out a chart, and we'll post this here, but he put out a chart highlighting. So he's like, if you account for all the debt in the system, so if you account for all the debt here in Canada, that if we actually do get, I think he said 6 rate hikes this year. So if you actually do get the overnight rate to about 1.5%, that it would be equivalent to the tightest monetary tightening since 1980. So again, just to reiterate, so basically what he's essentially saying is that your Paul Volcker moment in Canada is taking rates from 0 to 1.5%. Given the amount of debt that's in has built up in the system, in this economy, the amount of leverage in the household and corporate sector.
Does that include inflation though? Like inflation at
well,
5
I
and
mean,
6,
that's the
or
thing,
does it
right? I
go
mean,
beyond?
I couldn't tell you.
That's fair. That's okay.
Query research, David Doyle, I think he's a respectable person.
He is.
Could he be wrong? Could he be wrong? Very much so. But I think it was a very interesting chart that they put out, because I that's kind of my view. And I think it's been, my view from the get-go here is that the rate hikes are coming. But when you really factor in the amount of indebtedness that we've talked about, which is what Keith is saying, that, at the end of the day, this debt will have to be restructured in some shape or form over the next, 3, 4, 5, 6, 7 years from now, that there will be some sort of restructuring. Central bank digital currencies will be involved. Perhaps what Zoltan talked about, commodity-based currencies. There'll be some sort of Bretton Woods III system, and there'll be, certainly be winners and losers from whatever that new system looks like.
I have something cool to share with you. You may or may not know this, but who is the biggest issuer of debt in Canada? Which group?
Federal government, no?
Nope. Rich is going to open up his computer with I saw Rich's computer yesterday. I said, show me your work. He said, well, this tab here has 8,762 charts. I'm like, wow.
So you're saying it's not the federal government? I'm going to take a second guess. Could it be like the issuer of debt?
The single issuer of debt? Is this a trick question?
Yeah, this is
well, it's not a trick question. It's
okay.
It's the provinces on an aggregate level. So provincial debt is greater than federal debt. And the reason it's important is because federal debt, like the most liquid, I did research on this a couple of years ago, so before the pandemic, the most liquid provincial debt, I think it's the Ontario 10-year bond at the time. It had about 20% liquidity of the federal government 10-year bond. So remember when the provinces, like Newfoundland, had to get bailed out effectively back in March of 2020. And it was only because they were first up. They had an issuance coming up, and that's it. If it was Nova Scotia or BC, it would have been them. It just happened. Newfoundland had bad luck with it. So right now, if we're going down this road in Canada where, we could, growth is going to slow, say other things can happen. And remember, when you get a crisis, liquidity dries up, like money flows to the most liquid security, which would be the 10-year bond issued from Ottawa. Provincial debt, it dries up. There's no way you can get out of this stuff. However, I think we were talking about this earlier, there is one province, and actually 2 provinces in Canada, that will do very well coming up in this environment because energy has gone so high. And so Steve, why don't you share with us what you're talking about earlier?
I was just saying before the show, before we started recording, that I was talking about the bull market that's obviously happening in Alberta, particularly the housing market's exploded. I mean, it's off the charts. That I'm actually just reviewing it right now. So the Alberta government based its budget deficits on $70. So it was $70 a barrel oil. Obviously, we know where it's at today, north of 100. So again, will that continue? Maybe not, but I think structurally, I think that we're going to see elevated oil prices over the next sort of 3 to 5 years. Due to these supply constraints that are not just related to what's happening in Russia, but the lack of exploration moving forward. So basically, long story short, is Alberta is going to be running massive surpluses for at least the next couple of years. And as Rich said, that will probably equate to more. You'll see a lot more public schools suddenly start popping up because Alberta, it was suffering quite a bit. Talking about cutting like nurses and school teachers' wages because they were running these deficits, trying to get their balances back in line. Obviously, due to the oil bear market that we've had over the previous 5 years, and so that picture is changing very, very quickly.
Can I just ask a question though about so I understand the liquidity issue for the provincial versus federal debt. Mind you, I would say that it's probably a lot closer than it was, let's say 10 years ago, because of what's happened over the last 2 years. But my question is, doesn't the federal government just back the provincial, like after that liquidity event? and you get that like schism, wouldn't the federal government just be like, okay, we're gonna transfer 1-for-1 all of the provincial debt for federal debt? I mean, wouldn't that happen? I don't get why not though.
That's never happened. So they
But
might
I mean,
have to go down that.
I mean, never is a.
It hasn't happened yet, but that's the point though. So again, you go back to the Newfoundland experience from March of 2020. Again, they had, I don't know what the number was they just had to roll over. They had issuance to maturing. You got to roll it over.
But they're not going to let Newfoundland default. I mean, there's a way.
So here's what happened though, Rich. The Finmen in Newfoundland, they called Ottawa and they say, hey, we're in trouble here. Like we need to borrow in 4 days. And, our team is telling us, or our bankers are saying, there's no bid on this. So we need your help. And then all of a sudden the phone rings. It's Ontario. And they're saying, hey, like we need help here. We were not going to be able to roll over debt, and then Quebec calls and Saskatchewan and whatever. So what happened next is that they call the Bank of Canada and they say, hey, this is what's happening. We need a solution. I mean, that's what went down. So the Bank of Canada effectively backed the issuance for Newfoundland getting the debt. And
I remember that they did. If you look at the Bank of Canada's balance sheet, the growth in provincial debt went from 0 to I don't remember the figure, but it was a large portion of the balance sheet expansion at the onset of the pandemic.
Yeah, it really was. So I mean, I know a lot of investors in Canada in the fixed income world, if you want income, you're not getting a lot from federal government debt or mutual funds that are buying that stuff. So then you move up a step, you start buying provincial debt. So there are some funds out there, they just hold provincial debt. And just go back and look at what the experience of that fund was back in Q1 of that year, in 2020, or just for the month, and you'll say, holy smokes, this thing just dropped like a stone. And that's the point. If there's no liquidity in a market, then there's no one willing to buy it. And that's what makes US Treasury so great. You can buy and sell it like gobs of it one day to the next, and no, you ain't going to move the price that much. But the more illiquid a security is or a market is. So again, coming back to Canada, so like maybe the demise of Canada, I don't use that word demise, but maybe the event that escalates stress across the Canadian system, it comes from one of the provinces really running into trouble. So I don't know which province consumes the most oil. I don't know. I'm just taking a guess. It might be Ontario, maybe. But whereas Alberta should be doing pretty well over the next 12, 18, 24 months, maybe. There's always a loser on the other side. So if you figure out who that loser is, that's where maybe the spark could come.
Who's the most indebted province? Do you know? I don't remember.
It's probably Quebec. No, I'm kidding. I'm from Quebec, so I have to say that. I'm kidding.
I think it's Quebec and or Ontario on an absolute basis. It is Ontario. I mean, they have a ton of it.
What again, I was going to say, doesn't Ontario also have like the highest like tax rates too? Like it's just like, I mean, how much more blood can they squeeze from a stone?
Yeah, it's pretty high over here as well. So, but that's the point though. As long as you can continue to borrow, you keep rolling things over. But the moment that you can't roll over your debt, that's when it gets a bit tight out there. And as we keep talking about, like our view is that, a problem in Canada, I do not think it's going to be a domestic event. It's going to be an international event that will trigger something domestically. So that's why you need to be very keen and focused and interested on what's happening around the world with all this stuff.
Quick question for you. We'll wrap it up here, but do you have any thoughts on municipal debt? Like, is that from what I understand, municipalities aren't allowed to like legally run deficits, right? They have to basically run balanced budgets.
I think that's right.
Yes, but what do you mean though? Thoughts on it from which perspective?
I guess in terms of liquidity, they must have ran into a jam there. They did run into a jam during the pandemic as well. But
so most municipalities, like they're either borrowing, directly through a banking conglomerate or through the province and stuff like that. Some of the large, I would call like agency type debt, like Ontario Hydro, like those kinds of things are out there. But like, the city of Halifax, for example, if you can find their debt, it's not trading. Like it's locked up in a fund somewhere.
Funny story. I was chatting with a municipal government in Vancouver, and very, very well connected. But yeah, he was just saying like, yeah, it's like they're just talking about like real estate and development. Because this is our lifeblood of our tax revenues coming in. It's like the developers community amenity contribution. So like they're like, we need new density and new housing supply, or like he effectively said it's a Ponzi scheme otherwise, right? Like, which, I mean, I think most things in life turn out are Ponzi in nature, right? Like they rely on more and more debt issuance or taxation to sort of sustain itself. Oh, that's a wrap.
Yes.
So, there you go. That's your explainer on provincial and municipal governments and the coming changing monetary order. The wonderful Zoltan Pulzer here. Keith wants to have some final thoughts.
Yeah, Steve, why don't you mention, though, I think we talked about it offline, but we just share that we were thinking about getting together in May out in Vancouver if people are interested.
Yeah, so for the people that are watching this on YouTube, if you don't mind just commenting below, like, if you have any interest in attending, it would be fun. We'd make it fun. Obviously, it would be, I don't know if I say open bar tab, but maybe a couple free ones on the house, and just kind of a meet and greet. Maybe we'll do like a live Loonie Hour sort of show, something along those lines. If you'd be interested in attending in Vancouver this summer, please let us know. Just kind of give us a gauge of overall interest, but I think preliminarily it sounds pretty good. And as always, we thank you for your support. All we ask is that in support of this podcast, we don't run advertisements. We don't charge any money. All we ask is that you share this episode with at least, one person and help us continue to grow this community that we're building together. So appreciate it. We'll see you next week.